All right. Today is Sunday, the 28th of April. This is a recap for the stock market activities this week and an outlook for the week to come. And folks, I got a good one for you tonight. Folks, let me address something here because a lot of you say, hey Maverick, can I call you? Can I Skype with you? Can I talk to you over the weekend about the economy or the market? And all I got to say is how about no, not in the weekend. You see, Monday, Tuesday, Wednesday, Thursday, half day Friday. All what I do is the economy and the market. Everything I consume, everything I do revolves around the economy and the market, and I sleep about 4 hours a day. I don't even watch movies or TV shows or sports. I watch market and economic content. Weekdays, all about the economy and the market. Comes the weekend, you gotta shut it off. I don't want to hear about the market or the economy. I don't want to talk about them. I just want to get stoned and zone out. And then Sunday, I'll be ready to go back. So this is exactly what I did this weekend. I zoned out, and somehow I was wandering around a casino here in the city of Las Vegas. Now, of course, there's nothing for me to do in an actual casino because after working in the casino industry, I realized that the whole thing is a scam. The odds are against you, and the longer you play, the more you're gonna lose. Besides, I preserve all of my gambling in the stock market. At least that way you can utilize some insider information and the odds become in your favor. I like to gamble in a game where the odds are rigged in my favor. So gambling at the casino doesn't make sense to me, and I'm looking around, what do I do here? I see the movie theater, and I made a bet with myself here that I'm gonna watch the next movie playing. I don't care what it is, how dumb it is. I'm just gonna watch whatever is playing next. I go to the window and I ask the guy, what is the next movie playing? He says, Civil War. My reaction was, another Marvel stupid movie that I gotta watch because I made a bet with myself again. But the guy goes, no, it's not a Marvel movie. It's actual Civil War in the United States. That's what the movie is all about. So I thought, here we go, some stupid war movie or some political drama with a dumb woke angle. Oh my God, they rebelled against the United States, the bad Trumpers, right? And we fought them back and we won. We killed them. And the movie ends with a cheesy political message about how we should stick together and how we're stronger together, which is all bullshit. We're just staying together for economic reasons. Otherwise, we would be killing each other like monkeys. But anyways, to my surprise, the movie was not anywhere close to what I thought. It was a pleasant surprise. They didn't really care about the politics or the messaging or any of that. Matter of fact, by design, they don't want you to think about, what happened that led to the war or who rebelled against who and how it's gonna, none of that matters. And they did that by design by choosing the dumbest scenario, which is California and Texas unite against the United States, which will never happen. But there is a reason behind that. They don't want you to be concentrated about that angle of the movie. All we care about is there's a civil war in America, and here's the story of these photojournalists who want to take the risk and cover the Civil War. And it's fast, it's a lot of action, it's gruesome, more of an apocalyptic angle, like The Walking Dead, for example, rather than political drama or anything about politics or war. And then the movie ends just like that, no messaging, no stupid cheesy ending, nothing like that. I thought it was pretty good. It was a pleasant surprise. You know what the problem is though? I go back home from watching the movie, and my puppy, of course, had a party in the house, ripping pillows, chewing on laundry, ripping rugs, chewing on the couch, pissing all over the floor, and she's over 1 year old now, so it's getting out of control. And I'm beginning to give up on her. Maybe there's a reason why nobody wanted to pick her up. Maybe it is time to give her back to the shelter. I tried every solution I could, but I didn't find anything that really works. Until yesterday, I found a solution. So if you have a bad puppy, listen to this. I threatened my puppy that if she doesn't behave, I'm going to hire Dog Sitter of the Year, Governor Kristi Noem of the state of South Dakota, which is part of South Canada. But that crazy bitch shot her dog for not obeying her, and she's proud of it. Now you're going to wonder how her husband is dealing with this psychotic, deranged human being. He's probably the most submissive cuck in North America. You look at this picture here. She has the flamethrower right to his balls. Obey, submit, or else. And he's smiling ear to ear. Please help me. But of course, this psychotic person wants to be the vice president of Republican nominee Trump, which makes you really sad about the choices that we have this election season. You want to go back with bad or stay with worse? Until, of course, you realize that the elections don't really matter. The president is just a ceremonial position, and the true rulers of the country are the oligarchy. So there's nothing you can do about it. Might as well just relax and crack another can of beer and continue to watch football. And the country is going to end up in a civil war anyway, so who gives a shit? Doesn't really matter. You know what matters though? It's the economy and the stock market. So let's go back to talking about it since the weekend is over. And we have a really interesting week here in hand. It began with a correction that was long overdue. Some would argue it began because of technical reasons. Others, of course, will say no, it's because rate cuts are not going to happen this year and there's a possibility of a rate hike. Others would say maybe we've seen peak valuations. Whatever the reason is, the market entered the week under a correction. It got really oversold the prior week, so we were expecting a rebound. We got a rebound, a big one. But it wasn't just a straight line rebound. It came in a bumpy roller coaster ride because we had a lot of earnings. Meta dropped us down, then came Microsoft and Google lift us back up. And now, as in Friday's action, we pointed that out, we're now at the mercy of AI earnings, not the speculation about AI, whether Microsoft or Google spending whatever. Now we get AMD, Supermicro, NVDA, and we'll put that to the test. And that's going to become really important when we talk about the week to come. Stick around, we have a really good coverage for you, but this week was also interesting because the macroeconomics data that we got confirming stagflation in the economy. That's the confirmation that we're talking about in the title of this video. Big assumption is what happened after earnings, which is, yeah, Meta was bad, but then came Microsoft and Alphabet, and maybe they're still spending more, and that benefits NVIDIA. If NVIDIA goes higher, $2 trillion company, it lifts the market anyways based on the weighting alone. Big assumption that's about to be tested this week. But let's go back and review the market and the macro data that we got this week to set up the stage for next week. Of course, it's a battle between the bulls and the bears. Who got more this week? Because both sides are getting some data to support their arguments. But we have to look at the cumulative evidence, whether it supports one side over the other. And among the evidence we're going to review, which piece is the most important and the most impactful? Let's begin with the bear-bull battle. We began the week with oversold technicals. So right off the gate, the technical side goes as a score for the bull side. Let's give you more details. Last weekend, we talked about perhaps a falling wedge pattern on the daily charts on the indices. And that suggests that we have a rebound coming after a steep correction that got us oversold in some time frames. Maybe it is due for a rebound. We got a rebound, but the road was not really that smooth. Monday, Tuesday, we go higher. Wednesday, we consolidate a little bit. Then we drop down big because of Meta's earnings. Big gap down, but it was kind of dismissed. The dip was bought, and then came Friday on the heels of Microsoft and Google's earnings, and we see a rebound closing at the highs. Continuation of the rebound. And the question you got right now is, do we continue on this rebound, Maverick, or are we going to resume the correction again? Hold your horses. I'll show you the evidence of what I think. We begin step by step. Because what we're in right now is what is called a chop period. After a correction, which is an easy trade, we'll talk about that in a minute, we have a chop period, which is harder to trade. And the reason is you have the recency bias of dip buying coming back in, looking for any support. Once support is found, we begin to see that recency bias of, prior dips were bought and we went higher. Why would this be any different? And then you have the counter force with their own recency bias that we got a steep drop down, the first real correction that we've seen since last October. And sure, we're going to get an oversold rebound, but down we go after that. That's the other team's recency bias. These two forces collide in the chop period until a clear winner shows up. And this is why trading this period is a lot harder than trading the first drop or the second leg in the correction. But here in the Maverick of Wall Street, we tried our best to trade the week. We began with, okay, rebound, oversold. We don't have Meta or Google or Microsoft coming till later in the week. Let's play some rebounds. We went with the triple Qs, 420 calls for the week, and the XBI, the biotech ETF, with the 85 weekly calls. We didn't keep these rebound plays all the way till the end of the week. We held them for a day or two and then closed them right away. XBI, we closed it, 85 calls. The entry cost was about 70 cents a piece, and we exited the trade with a value of about $1.50 a piece. Nice profit, nothing to complain about, over 100% in a couple of days. And we also closed the Qs trade, the 420 calls. The entry cost was about $3.45 a piece. We exited with a value of about $5.60 a piece. Nice profit, nothing to complain about. that we did one for the XHB because of housing data, and of course the fact that yields are cooling off a little bit, at least Monday, Tuesday, we might see some more rebounds. We went with the 105 XHB calls with May 19th expiration, but we had to close it the very next day, and the reason is we began to see yields moving back up. So we closed the trade and it was still profitable, pretty good. Entry about $1.60 a piece. The exit was about $2.40 a piece. Not bad. Then came the drop down. We anticipated it ahead of time. We played it, but it was short-lived. So if you didn't close, you didn't gain. We did this via Tesla 155 puts for the week. Of course, that did not work out because Tesla did not correct enough on Friday. But we'll look at the chart again in the charts analysis. Maybe we have a trade on it next week. But we also did NVDA, the 800 puts, and this played out beautifully. This was the chart for the trade before the trade. Here's the update. We got a drop, and the 800 puts appreciated in value pretty good. The entry cost was about $11.40 a piece for the 800 puts, and it appreciated in value to more than $25 a piece. So we issued this per morning brief. The NVIDIA 800 expiring this week almost hit the target. Now either you book your profits or take advantage of higher implied volatility by opening a spread. I'm opening the 750 puts expiration date next week to have a debit put spread. 800, 750 expiration date next week. Opening the 750 puts shaves off about $700, because we're talking about contracts now, or $7 a piece of the entry cost, and reduces the risk from any rebound. So consider these options: either close, book profits, or open a spread against the 800 puts you got. Now, closing was the wisest decision. Opening the spread was the second wisest, because NVIDIA with a huge rebound on Friday, we'll talk about that in a minute, why it happened. Huge rebound on Friday, 6%, and that reduced the value of the 800 puts by a lot. Now, if you have the 750 that you opened, you're down, but you're not down that much. Meaning, if NVIDIA goes down next week, there is hope of repairing the trade. But if you stayed naked with the 800 puts, you're dead. If you closed, okay, you did the right decision, good for you. But we also played the drop midweek in the S&P 500 and the Nasdaq via buying the SQ's weekly 12 calls. The entry was about $17, and once we got the drop in the Qs, we closed it right away at a value of about 55 cents a piece. Not bad, because the next move was a big rebound Thursday into Friday. Of course, we're going to talk about how to play those next week and what we're anticipating in the charts analysis. But here's what you got to keep in mind, folks, in the big picture. We're still talking about technicals now. For the week, it was bullish. We're talking about the shorter time frame. What about the longer time frame, though? What about this upcoming week and the week after? Isn't the trend bearish now? Let's look at the facts. Here's the daily chart of the SPY. I gave you this on Discord before the close. In the last correction, we got the first leg of the correction. Then we got a big rebound, almost recovered all of the losses. Then came down again with a second leg of the correction, then a third, and then the correction ended. The assumption right now is the rebound that we've gotten this week is just a process of the correction. There is a threshold, of course, when we say, okay, it is no longer a correction, and that is, of course, making a new high, but that would be too obvious at that time. So we try to spot leading indicators to that. But for now, the assumption still holds. We got the first leg of the correction. We got the rebound. Maybe it has a little more juice to it, but the assumption is we get a second leg of the correction, meaning there is no V-shaped recovery out of this. That's the assumption for now. And if we go back to the behavior of the last correction, this is an hourly chart of the S&P 500. This is the correction from last summer. You can see that we got a reversal pattern with that big gap and crap. That was the warning sign that, okay, the rally is coming to an end. Now, the juiciest part of any correction is when the volume is the highest and the trading is going in one direction. It makes it easy. The volatility increases. You make big bucks. And I call this period the juice. Why? Because it is juicy period. That's what traders live for. The initial leg down, we played it pretty good on this channel, but then comes the chop period. Recency bias for the bulls says that every dip was bought. Why would this be any different? Recency bias by the bears is, no, we're now doing something different. And there is more where that came from. So we see a battlefield. You see huge moves up, huge moves down, and trading becomes really difficult and challenging during the chop period. And the market makes up its mind, and usually in a correction, it is a multi-leg event. So in the case of last summer, the bears won, and we've seen the second leg, and that's again a juicy trade, much better than the chop. Easier to follow, volume is heading in one direction, implied volatility increases, you make a lot of money trading these puts. Chop, you're gonna have extreme precision. We tried our best, folks, and we still missed a lot of things. So as a trader, you pick your battles. You want to be involved in the chop? It might not end up being the easiest trade for you. It might actually cost you. Maybe you want to wait for the juice, whether the juice comes to the downside in the second leg of the correction or in the recovery. And then comes the short covering and the stampede, and that's an easier trade than the chop. Now, if we apply this knowledge to the look that we have right now, this is a chart of the S&P 500 hourly chart as we have today. We identified the island top pattern, and since then, the market couldn't really trade above. That was the top, and from that point on, all the way till the market got oversold, that was the juice. Easy trade, big drop down, implied volatility moves higher, lots of money to be made. Now we're in the chop period, a lot harder. And this time around also coincides with earnings season, so we see huge volatility up and down. And for all you know, we can open Monday with a huge gap down. So again, as a trader, you pick your battles. But if you're going to be involved in chop, understand it's not going to be easy. Now, in the question of whether we're going back to the highs in the V-shaped recovery, there's a case for that. I'll show you in the charts analysis. But the rationale, the history, the technicals, the longer-term charts all suggesting that this chop period will come and go, and then we have another leg down. We'll talk about the technicals in a minute, but let's go back to the bull versus bear scoreboard. Technicals, we talked about it in details. It goes in the camp of the bulls. They closed at the highs of the week. The drop in Thursday's session was short-lived, and as you'll see in the charts analysis, we have a pattern of a higher low. So from a shorter-term perspective, the technicals, a win for the bulls. The bears can argue about what about the weekly chart, the monthly chart, I got you. But now we're talking about the scoreboard for the week. Really narrow time frame. Then came the PMI data, and that goes in the camp of the bears. I'll give you the summary from my macro brief that I do in my Discord, and you tell me what you think. PMI data. Here are the most important findings. Number 1, the latest rise in output was the smallest in the year-to-date period. Number 2, April saw an overall reduction in new orders for the first time in 6 months. Number 3, companies responded by scaling back employment for the first time in almost 4 years since 2020, the pandemic. Number 4, business confidence also waning to the lowest since last November. Number 5, input costs and input prices rising less quickly at the composite level. But number 6, manufacturing input cost inflation hit a 1-year high. Obviously, points 1 to 4 indicate that maybe the economy is facing some recessionary force. Maybe we have some stagnation in the economy. Pace of economic activity is slowing down. Whether you look at employment or output, then point 5 and 6 support sticky inflation and even higher inflation in the manufacturing side. You combine both together, and we have a stagflation period in the economy. And this was inevitable. The Fed had a choice. You got inflation, either you fight it all the way, you go the distance, you get a recession, or if you stop midway, you're gonna get stagflation. Then you have to do the job again and get us into a deeper recession. So the PMI data solidly in the bears camp. Then came Meta's earnings. And Meta went down double digits. So what is the problem? Because the year-on-year numbers are phenomenal for Meta. But it's all about the sequential. We talked about this before when we talked about bubbles. Sequential growth, net income, that's what really matters, specifically in a period where higher rates are dominant. It comes down to the bottom line. And if you look at the net income sequentially for Meta, it bottomed at around, let's say, Q3, Q4, 22. That's exactly when the stock bottomed. And then net income was expanded dramatically as the company began cutting costs. With that came the recovery of the stock Meta. But now sequentially we see a drop in the growth of net income worth about 12%. So the assumption now becomes maybe the expansion of the margins of the company have hit a peak. And we can throw whatever reason we want. Oh, they're spending on the metaverse again. They're buying more chips. They're not making enough revenue. We can argue about that all we want. What matters is what the market sees. Sequential growth in net income goes down. I'm dropping the stock. We have peak valuation here. Now, of course, the other important aspect for Meta comes from what happens to TikTok. The bill already passed to ban TikTok. The argument is somebody, an American buyer, will buy the company and problem solved, but the Chinese are never going to sell the company. That would be insanity. And now they're talking about if all other legal options fail, ByteDance prefers that TikTok shuts down for good. Suppose that happens. Where would the traffic migrate to? If the answer is Meta, then now we can talk about, okay, the drop in net income sequentially will be recovered because now we'll see more traffic in Meta and more advertising revenue. So this will be an important story for the name. And we played Meta's earnings. I would say was the best trade that we've done this week, because we got losing ones. I'll show you that in a minute. But on the meta trade, we bought the 420 puts. That's it. Why the 420? Because the price was too high. This is for the weekly expiration. Cost us about $1.25 a piece. And we closed it the very next day, early on in the morning, and we captured about $9.50 a piece. That is a huge profit from the meta trade. Then came GDP data, and that goes as a score for the bears. Why? Because it solidifies what we got from the PMI data. See, even the media now is catching up to it. CNN says fears about stagflation are mounting in the U.S. It is every central banker's worst nightmare. Well, are you saying that Jerome Powell didn't know about this? He never really studied what happened back in the 70s with his look-alike, Mr. Burns? If that is the case, then the man is incompetent and he should be sacked ASAP before he does any more damage to this country. But of course, we know why Jay Powell got us into stagflation. It is the pursuit of the fantasy of the soft landing. Had he accepted a mild recession, it would have been over already. Stock market would have gone down. That's the price, though. And he didn't want to do that. He didn't want the stock market to have a natural correction in a recession. He wanted to keep the assets of the wealthy fluffed up, because that's his job. His real job, real mandate. And he abandoned his fight against inflation. We've seen a recovery in the stock market, of course. But now the question becomes, is the job done or not? And if it's not, then the rally in the stock market is not justified and will be taken out. But one step at a time, folks. Why do we say that the GDP data supports stagflation? Well, here it is. GDP, the estimate was 2.5%, the actual reading 1.6, a huge miss. Personal consumption supposed to be 3%, we got 2.5%. That's a miss. But the PCE component of the GDP, PCE meaning inflation, expectations 3.4, we got 3.7. So again, you got the same evidence, weaker economic activities, but we have higher inflation. Well, the combination of both is stagflation, worst economic phenomenon, and really hard for the Fed to deal with, because the solution, the remedy would be to raise interest rates higher. But if you do that, you've already done a lot of damage in the economy. Something is going to break. Now the mild recession becomes a really severe one if we have a financial crisis or an accident, which is prone to happen when you keep raising rates. Even Business Insider now says the U.S. economy may be barreling towards stagflation, an outcome worse than a recession. We said this in this channel, folks, long time ago. Recession is not really that bad. Recession is the remedy of inflation. It resets things. It makes pricing cheaper for the consumer in the long run. Stagflation is the worst. When you dig into the details of GDP, consumer spending on services, that actually moved higher quarter on quarter. That's contributing to the inflation part. But if you look at consumer spending on goods, that went negative quarter on quarter. And of course, the GDP is a bullshit number because it can be easily manipulated. For example, this reading is bad because net exports went down big quarter on quarter. If that rebounds in the next quarter, you'll see a rebound in GDP, assuming everything else holds the same. So we don't take the GDP seriously, but the point being is the evidence that we got from it supports stagflation. That's the point for the bears, because stagflation means either rates will stay as high as they are for longer, no rate cuts, which means something is bound to break. And we hit a hard recession either way. Or the Federal Reserve will freak out from one inflation data point that will come way too hot, and they will begin raising rates again. And that's going to take the market down. That's going to take the economy down. So GDP data pointing out for stagflation supports the bears camp. But then came Microsoft and Google's earnings. Those go in the camp of the bulls. And this is why we were able to turn a blind eye to the macro data that we got. Whether that's going to last or not, that's a different conversation. But it shows you that the immediate attention in the market is toward earnings, not so much the macro data right now. Bear in mind that earnings for Alphabet, for example, were not that good. If we talk about sequential growth in revenues for Google, it was actually negative 7%. For YouTube was down 12%, but the net income, that's the most important one, was up 14%. And of course, maybe the stock was bound to go down, but this piece of data of net income sequentially going higher, and the dividend news and the buybacks caused the stock to pop. Now, in the next week, we need to see what investors really think about the sequential growth or lack thereof when it comes to revenue and YouTube growth quarter on quarter. If they rethink it, we see the stock going down, dividend or no dividend, buyback or no buyback. Microsoft, on the other hand, the earnings were pristine if you look at them year on year. It's the strongest company in the market in the economy right now. The problem is net income has stalled. The peak was Q3 23, and since then the company wasn't really able to beat that number. So if you look at it all in all, we might be spotting the beginning signs of peak growth in these big cap companies. And this is why the reaction from Microsoft was lukewarm. There was an important finding, though, that trumps the earnings from Microsoft and Google. We'll talk about that in a minute. But we've also done trades for Microsoft and Google. For Microsoft, we're going to consider this one a loser because we bought the 440 calls, calendar calls, and 360 puts, also calendar. And the move was not that big to favor one side versus the other, which makes the trade pretty much the odds say it's going to be a loser. The Google trade, on the other hand, we've done the 170 calendar calls combined with the 140 naked put for next week. And at the end of the day, the move was larger than what we wanted because it went above 170. That's not the ideal scenario when you have calendar calls. But it did work out. We were able to squeeze some profit out of it, so it did work out at the end. But here's the most important finding, folks, for Microsoft and Google's earnings. This is what the market understood. It's not about Microsoft. It's not about Google. It's about their spending. And if the capital expenditure by Google and Microsoft is going higher, where is it going higher? What are they spending on? The market assumes that, oh, it's NVIDIA chips. And this is why Friday, the biggest benefactor was actually NVIDIA that went up 6%. So it brings back AI optimism on the table that, wait a minute, maybe it's not over. Maybe these big cap companies are still spending like a drunken sailor, buying chips from NVIDIA. And the market decided on Friday that this AI optimism, the revival of the AI optimism, is more important than anything else. And the reason is if NVIDIA, a $2 trillion company, goes up by 6%, 10% in a single day, it doesn't matter what the rest of the market does. The weighting of one giant overshadows the rest, and the market goes higher. Now, the problem is we have earnings coming this time around from companies like AMD, from companies like Supermicro Computer. And if these companies disappoint, then they will point out for slowing demand in AI. And then we're going to realize that, oh, Microsoft and Google's spending is going somewhere else, not heading to NVIDIA. And if that is the case, NVIDIA drops, takes the market down with it. And the last piece that we got this Friday was PCE data. And that goes in the camps of the bears. It was a beat in the PCE, which is the most important indicator for the Fed, and the most alarming find is if you look at the 3 months trend or the monthly trend, you will find out that inflation is actually surging higher, and there is absolutely no way, no possible way, the Federal Reserve will begin cutting rates under this circumstance. Unless, of course, there is a disaster in the economy and it merits a rescue. The question now becomes, what if earnings pass and the market stops caring about earnings anymore? The concentration goes back to the macro and the rate cuts. And the macro now supports no rate cuts. Perhaps the odds are higher for a rate hike. Then the market is not going to like it. So the digestion matters. And we see rates on bonds going higher. The Fed can talk about rate cuts all they want. At the end of the day, the bond market decides what's going to happen next. And the bond market is saying no rate cuts, the possibility actually for a rate hike. Rates continue to go higher for inflation reasons, for the insane spending that we see by the government, all of the wars that we have to pay for. There is no reliable buyer for our debt anymore. So we see these awful auctions happening week after week, pushing rates higher and higher and higher. Not to mention, of course, the dumping of U.S. bonds by China. That's also factoring in and pushing yields higher, which leads us to what if it's not just China alone dumping? What if Japan joins the dumping party and yields continue to go higher and higher and higher? Then that's going to pretty much guarantee and seal the deal that you can talk about AI all you want. At the end of the day, the Fed will hike rates, and that's going to end the party once and for all. But the important event is, will the Bank of Japan really join China and begin dumping U.S. bonds in favor of Japanese ones, or not quite yet? See, I'll have this in the neutral side for this week. It was bearish throughout the week until Friday, when the Bank of Japan backed off and they held rates steady. They say inflation is expected to stay at 2%. Already, good luck with that. Look at the yen. The yen is dropping like a rock. Soon enough, it'll be worth less than toilet paper. The Bank of Japan wants to do something about it because the collapse of the currency guarantees higher inflation. But the Bank of Japan is not independent. And I said this in my Twitter account. And that goes, by the way, for the ECB too. Both of them are owned, controlled, and dominated by the United States and the Treasury Department. They cannot do anything without the blessings of the U.S. Treasury. And the reason is that the Bank of Japan, in this case, decides to go hawkish and raise rates to fluff up the yen. Then what do you think will happen to the rate on U.S. bonds? If the Bank of Japan now buying more Japanese bonds, than U.S. ones. Yields will go higher here in the U.S. And Janet Yellen doesn't want to see that before the election. She's been fighting it with the fake news, with the auctions will be less, all the manipulation she's been doing. She doesn't want the Bank of Japan to ruin the party. She's already surprised by the recent surge in bond yields that caught her off guard. She doesn't understand what to do with it. Well, maybe, Mrs. Yellen, it's because of the insane spending you're doing and the Federal Reserve abandoning the fight against inflation. Maybe this is why we're seeing bond yields going higher in coordination with higher inflation expectations. If the Bank of Japan dumps U.S. bonds, rates are going higher and higher and higher. So Yellen says, Bank of Japan, don't do it. Not right now, even though the Bank of Japan wants to do it. And that goes for the ECB. There is no rate cut from the ECB until the Federal Reserve and the U.S. Treasury give their blessings. Otherwise, it's not going to happen. No matter what Madame Lagarde says, she's not in charge. Yellen is. With that understanding out of the way, the collapse of the Japanese yen is, of course, causing inflation. Part of inflation is the inflation of stock prices. So we see the Nikkei in a mania mode, in a bubble. But think about it this way. A stock like Disco, or Mitsubishi, or Subaru, or whatever stock you want to pick in these dorks in Wall Street, now they say the 7 Samurai. They had the Mag 7, now what is it, the Mag 3? So they're talking about the 7 Samurai now. In any case, if you're a Japanese investor and you held stock in Toyota or Subaru, and the value of the yen collapses, the appreciation in the value of the stock that you hold, Toyota, Subaru, Mitsubishi, doesn't matter which one you hold, is moving higher to compensate for the drop in the value of the yen. Because what was worth 50 back then is now worth 150. 50 yen used to equal whatever US dollars. Now it doesn't, so the price has to go higher. In one way, it's a hedge against the collapse of the currency. But net, as a Japanese investor, you didn't make shit. Your stock price went higher, but it's only factoring in inflation. Net, you're even. As a foreign investor, though, yes, you're making money, chasing the mania in the Japanese market. You're buying via dollars to yen, and then you're cashing your profit from yen to dollar. But again, don't be deceived by the stock market rally in Japan. It is only factoring in inflation and the collapse of the currency. You look at inflation expectations, that moved higher in Japan, staying higher. Multi-year high. This is a good chart from Tavi Costa from Twitter. You see the devaluation of the yen causing rising inflation expectations in Japan. What am I trying to hint at here? This issue is really important. What the Bank of Japan will do, the currency crisis in the yen, that's critically important to the market right now. And the higher inflation goes in Japan, specifically inflation expectations because of the collapse of the yen, the Bank of Japan will feel the urgency that they have to do something. At some point, would they complain to Yellen too much that, look, we can't hold it anymore? We can't continue to watch our currency collapse and risk higher inflation just because you don't want to get hurt before the elections. We're going to do it. We have to do it. In other words, the action by the BOJ is inevitable. They're going to have to rescue the yen. They're going to have to raise rates. In other words, rates in U.S. bonds will go higher because the buyer of our bonds, Bank of Japan, will no longer do so at the same pace, meaning whoever left as a buyer will now require higher and higher rates to assume the risk of our debt. That's what Yellen doesn't want. That could be the black swan. So for now, the scoreboard goes, it's a draw between the bears and the bulls if we look at the data. And now comes next week. We have a lot of macro data. Stick around till the end of the video. We'll show you the calendar. And then we have a lot of earnings coming, specifically AI-related earnings, because the most impactful factor and piece of data in this battle between the bulls and the bears, which ended up in a draw, but the market went higher either way, is the revival of AI excitement. Because of the earnings from Google and Microsoft, folks are now assuming NVIDIA should be higher because the revenue of their profits will be higher. If that assumption is negated, the market doesn't have it anymore. And the mounting evidence will be in the side of the bears. We see the second leg of this correction. Interesting week ahead. So let's add more color to it and cover the market information that we got this week. And we begin with the closing of the indices on Friday. And here we go. The diamonds in the green by 153.86 points, or a gain of 0.40%. The Nasdaq, the winner of the day by far, Microsoft and Google, up by 316.14 points, or a gain of 2.03%. Of course, the contributor in the trading day was NVIDIA. Pretty much 90% of the gains came from NVIDIA. The pre-market gains came from Google, Microsoft, but the biggest contributor the intraday gains was NVIDIA. S&P 500 Spider up by 51.54 points or a gain of 1.02%. And the small caps, Russell 2000, with a rebound worth about 1.88 points or a gain of 0.96%. We'll look at the sectors on Friday. Comm services at number one. No surprise, Google has a huge weighting, up over 10%. That's going to cause a huge explosion in the gains in comm services. Technology comes at number two. Thank you, Microsoft and NVIDIA. Cyclicals number three. And the laggards, utilities and energy. Utilities was the winner for the week, at least was. And then energy was the winner on Thursday. So you see on Friday, the theme shifted into risk on AI mania. And the gains from Friday tilted a lot of the calculations for the week. You see technology and comm services came at number one, number two. They were lagging all the way till Friday. Then they made a comeback. But every sector, folks, was positive for the week. It indicates the nature of an oversold rebound in the indices. We look at the breadth for the NYSE, 65% advancing versus 33% declining. The NASDAQ, 61% advancing versus 36% declining. Slightly positive, but close to neutral, nothing crazy. Exactly how the market loved to close. When we talk about the market, we're talking about the market maker. But let's do the heat map here for Friday. What do we see? Not a good reaction for the market if you look at other sectors like energy, some healthcare, defensives, utilities, financials. But then you look at the big caps. Microsoft, Google, of course, because of earnings. Amazon catch and empathy rebound with them. But it's all about NVIDIA and the AI mania. That's what the market got from the earnings of Microsoft and Google. So we see NVIDIA up 6%, Broadcom up about 4%, AMD up big. But the notable absence in technology was from Apple. Apple was down on Friday, failed to close at 170 or above it. And that's a bad indicator for the market because once the excitement fades from Google and Microsoft, you have Apple still with downward pressure. And then you have Meta with more renewed downward pressure. Amazon will see what their earnings say. But of course, the most immediate risk here is what if the positive assumption from the AI mania that we got on Friday is negated by earnings from, say, Supermicrocomputer or AMD. That will be the biggest event of the week. Besides that, you see that the biggest laggards such as ExxonMobil or AbbVie in healthcare or Intel in chips down about 9%. All of that came from earnings. If we look at the weekly trend, what do we see here? Once again, it's earnings, so you see the contrast. The big caps all up, exception Meta, down about 8%. The chips all up, exception Intel, down about 7%. Most of the other components of technology are up, but then you have IBM down 8%. You see it in financials. Majority of the sector is actually positive, but the insurance company is down. You look at industrials. Majority positive, but Caterpillar down. The trucking names like Old Dominion crashed this week. You look at healthcare, majority of the sector are positive, but then you look at AbbVie, that's down 4%. You look at Bristol Myers, down 8%. Same goes for comm services, Meta down big, which we just talked about in the big caps. So all in all, we see the market moving higher in a rebound, oversold rebound, but then we have big drops from important names that did not really please the market with their earnings. Luckily for the market, the most important component that you see in this map right now, which is the semiconductor component, NVIDIA, Taiwan, Broadcom, AMD, those were outsized gains. We're talking about 15% for NVIDIA, 11% for Broadcom, 7% for AMD, 8% for Taiwan, 17% for ARM. Collectively, the huge gain from one big component of the market outweighed anything negative that we've seen throughout the week. And here it's illustrated even better. If you look at the heat map for the ETFs, the weekly look, we'll see that the TLT was down, means that yields were higher for the week. Didn't upset the market though. Why? Because we see oversized gains from the chip component. You look at the SMH up about 9% for the week. The SOXX up over 9% for the week. Every other gain you see in the map is modest, 1 to 2%, 3% in some cases, such as the XLY because of Amazon. But besides that, the majority of the gains came from the chip sector, namely NVIDIA. We've seen a correction in metals in the week. So you see the GLD down about 2%. Gold. SLV down 5% silver. But the miners, gold miners GDX did pretty good. Closed positive. That's also because of earnings coming from Newmount. When we look at international markets, it's interesting the rebound from Chinese equities. This is a theme that we're watching and maybe it has more leg to it. We know that because if we switch to commodities, look at the performance of copper. We have seen a correction in metals throughout the week because the dollar went higher, so gold went down, silver went down, platinum, palladium went down, but copper continues to hold. Copper sniffs recoveries earlier than anybody, and right now it sees or sniffs a recovery in China. so it continues to go higher. Whether that's going to last or not, wait for the charts analysis. I don't think it's going to last. I think copper is going to correct too, because we have a recessionary scare coming. We'll talk about that in a minute, but the Japanese yen down about 2% on Friday alone. The response, the dollar is up by about half a percentage point. Well, this is adding a lot of pressure on a lot of commodities. So we see on Friday's session, flattish activities for energy, natural gas, of course, no surprise, is the laggard, down about a little over 3.25%. But we see cocoa futures and softs pulling back a little bit, coffee futures down about 2%. It's not hammering OJ though, or lumber, both with rebounds worth about 1%. And the rise in the dollar on Friday dropped lean hogs and meats down about 2.5%, but modest rebounds for live and feeder cattle futures. When it comes to grains, mixed action across the board, but the weekly pattern is what really matters when it comes to grains. And the reason is, believe it or not, the winner of the week was actually wheat. Wheat futures up over 9% for the week, almost 10%, unbelievable. Then you see OJ, the NASDAQ, energy futures, inflation, the RBOB, almost gaining as much as the NASDAQ. Brent was positive about 2.5%, so was the WTI up about 1%. So the action all in all is inflationary. We've only seen pullbacks in cocoa worth about 6.5%, and a pullback in coffee worth about 3.5%. But these have been rallying aggressively. A drop of 6%, 7% would not really end a positive trend. And the inflationary factor is coming from coffee and cocoa futures. Moving on to the big casino, the options market, what do we see here? Options expiration Friday, lots of excitement about maybe the dip is worthy of buying here, so we see volume coming back into the picture. We see all of a sudden calls being bought. Now we're moving to the 60, 65, 70% plus calls versus puts, which could be an indicator that Johnny come lately to the rebound, and we actually dropped down begin the second leg of the correction. Now, if we look at the bullish versus bearish flows, so we talked about NVIDIA moving higher on Friday. And the fundamental reason is, Microsoft and Google spending more. What are they spending more on? We don't know, but we're going to assume it's NVIDIA. But mechanically, how did the move happen in NVIDIA? How about $80 million worth of flows, bullish flows for NVIDIA? Now, $80 million in options lingo means multi-billion dollars worth of bullish bets in notional volume. You wonder why the stock is up 6%? It's options. And then we look at the bearish flows. We see the SPX, the cash index, the IWM, small caps, Amazon, Tesla, and Adobe. And the most interesting trade here is for Adobe. We know we have an earnings report coming out soon for the name. And somebody's already betting against the name here, buying the 630 puts and the 620 puts, expiration date June 21st. Spending about $5.5 million in those. So keep an eye on Adobe's earnings. Somebody's betting they're not going to be good. Let's look at other unusual activities that we got on Friday. We begin with the ticker COIN Coinbase. Somebody's betting for a big move higher in the name. Perhaps a rally coming for Bitcoin. And they bought the 255 calls for the expiration date May 3rd. The expectations, the name will move higher and gain more than 8% by then. Paid about $8 a piece, stellar this trade. All in all, spending about $15 million for a trade that expires May 3rd in 1 week. The level of gambling is unbelievable, but maybe they know something that you and I don't. Here's another one for the ticker TECK for Tech Resources. Now the stock is up big for the year, and somebody's betting for more gains to come. They bought the 55 calls for the expiration date July 19th. The expectations, the name will gain more than 9% by then. Paid about $2 a piece, stellar this trade. All in all, spending about $2.5 million. And the last one we got for you here is for XPO. Now this is part of the unexplained. It's one of those charts that just keep going higher and higher and higher despite the fundamentals. And the question now becomes, since we got really bad earnings from UPS, from Old Dominion, from JB Hunt, the earnings were not really that bad, to be honest with you. But the reactions of the stock, or the stocks in this case, were absolutely horrific. And now it's a huge test for XPO. Is it beginning to correct to, or is it heading higher? Is something special here about XPO? This is at least what this trader is betting on. They bought the 120 calls for the expiration date May 17th. The expectations, the name will move higher and gain more than 8% by then. Paid about $4 a piece, stellar this trade. All in all, spending about $2.5 million. Let's do the charts before we wrap it up. and we begin with the SPY, the S&P 500, an hourly chart. What do we see here? What matters is the close. We closed at the highs of the week above the previous rejection point from the week, 547.37. Who has the advantage right now in the hourly chart? The answer is the bulls. Here's the problem though. Look at the MACD indicator. I'm highlighting the points where we've seen crossings. From bullish to bearish, then back from bearish to bullish. Where do you think the next move is going to? Another move higher? Because right now the candlestick pattern is of a bull flag, suggesting that higher we go. But is the momentum on the hourly chart peaking and about to reverse from bullish to bearish? If that is the case, you'll know that once we trade below 507.37. Then it means we're heading down to close the gap, and if we rebound from the gap, it's all good. So long as we pass 507.37 again. If we go down to the gap and we lose the gap and we trade below, then understand there's something different going on here. Perhaps the resumption of the correction is about to come. You look at the daily chart. Who's in charge? Definitely the bears, but we've seen a decent recovery here, a rebound that got us all the way back to the 20 days moving average in white. Momentum is improving in the hour sign, the MACD. Now, of course, the threshold becomes, can we close above the 20 daily moving average? If we do, the bulls will gain even more momentum and you'll see more energy speculating on, okay, maybe this is going to be a V-shaped recovery. I don't want to miss it out. Psychology will become important. The problem is we talk about the landmines, folks. And if you step on one and it's big enough, it kills everything. You got a little taste, a little warning for Meta. But if the next one is involving NVIDIA, such as AMD or Supermicro or computer blowing up, that's going to kill the market because it's going to kill NVIDIA, and then it doesn't matter. You close above the 20 or 50, doesn't matter. Suppose we close above the 20. What is the next threshold to have a confirmation that we're done with the correction? Crossing above the top of the breakdown candle, 515.30. So one step at a time. Weekly chart. The SPY again. Got a rebound of the 20 weeks moving average. That is expected. Is it a reversal yet? The answer is no. Not until you close above once again. Top of the breakdown candle, 515.13. In the meantime, the momentum indicators, be it the MACD, be it the RSI, be it the Vortex, all indicating that the predominant theme right now is bearish, not bullish. And whatever rebound you're getting from the 20 weeks moving average, we're going to lose that. And then we're going to resume the correction again. Until what? Till we cross above 515.13. Then correction is done. If we look at the hourly chart for the E-mini futures, what do we see here? Really hard to see anything meaningful. All what we know is we formed a bear flag. We went down on a retest to 50.22.5. We caught a strong rebound from that point and we passed 50.92.5. So closing at the highs of the week, it leans bullish, but there's nothing decisive here, unless, of course, you zoom out a little bit. You use a 4 hours chart, clean up the chart a little bit. Now we see an inverse head and shoulder pattern meeting a sloping line of resistance. In other words, if we see the inverse head and shoulder failing at the same resistance line, then the bearish trend continues. If we close above, then the bearish trend is losing. We're now beginning to form a new bullish trend. So I'm giving you a lot of indicators here, a lot of things to look for, so you can make your own decisions. You know what to look for. If we're above this or if we're below that, you gotta trade. The Q's hourly chart, what do we have here? Again, drop from the bear flag because of Meta, then came the dip buying, and we closed at the highs of the week on Friday, above the previous point of rejection at around, let's say, 430. I say in the hourly chart, the bulls are in charge. And maybe this is a bull flag pattern, but again, look at the MACD indicator. You see the crossings, the most important crossings from bullish to bearish, bearish to bullish. The question now becomes, where is the next momentum in the hourly chart going to? If it's done with the bullish momentum and it will switch back to bearish, then we have a drop down, and then we got a bunch of lines to look at. 430. If that is lost, it weakens the bullish look here, but it's okay. You lose 427.55. It weakens the look even more, but it's okay. You go down to closing the gap and you trade below the gap, then we got a problem. That perhaps the bearish reversal will morph into the second leg of the correction. And in that case, we have to look at the daily chart. Got the rebound. We're at the 20 days moving average almost. The indicators are improving, but any failure from here will be a confirmation that we're going to head into the second leg. So you need to see the market moving higher consistently all the way till the upper Bollinger Bands. Any failure would be a problem. If you look at the weekly chart, why do we say that? We're above the 20 weeks moving average. But we don't have any bullish engulfing candle to confirm a reversal from bearish to bullish. Once we close above 442.15, then we got that confirmation. Until then, any rebound should be treated as transitory, absent of crossing 442.15. Then we know correction is over. Otherwise, you look at the MACD, you look at the RSI, you look at the Vortex indicator, all indicating that we're still in the bearish momentum, and that's just beginning. So again, shorter time frames, the bulls have it, but in the longer time frames, it is still bearish. If we look at the Nasdaq futures hourly chart, what do we see here? Perhaps a pattern of, again, inverse and a shoulder, with the real test now becomes 18,121.5. If we close above, the bulls will gain more ground. If we lose 17,735.75, then there's a failure to launch from the inverse and a shoulder pattern. If we look at the IWM hourly chart, weaker than the SPY and the Qs, got a rebound on Friday, but we haven't made a new high. We've seen that in the SPY and the Qs, not in the IWM, which some would argue a leading indicator. I disagree, but to each his own. What do we see here? Maybe a double top. Any failure from here will confirm a double top on the hourly chart of the IWM. On the daily chart, what do we see here? We're retesting the 100 days moving average in blue. We have improving momentum, as you can see in the MACD. We're about to cross from bearish to bullish. We have a pattern of higher lows. So far, so good in the daily chart. You need to pass the 100 days moving average. You pass the 20, and now IWM bulls gain more and more advantage, more and more momentum. The problem is you look at the weekly chart. We talked about this last week. Whatever rebound you get, so long as we close the week below the 20 weeks moving average, then look at the momentum indicators. The MACD is pointing out for the beginning of bearish momentum, and we have plenty more to come. The vortex is also pointing out from the same fashion. Until we see a huge repair job on the hourly and the daily, the weekly charts suggest that the correction is not over. If we look at the daily chart, what do we see here for the dollar? Bull flag persists because we got a recovery and we closed above 105,658. You can ignore the dollar all you want. I'm talking about the market here. But if this bull flag plays out and we break outside of range, say 106,613 basis points, the market is going to notice. Why? Because the algos will notice. What does that do to the old man gold? You see the bull flag in the dollar, you see the bear flag in gold. Gold is under a correction. We know that because you look at the MACD, we have a crossing. You look at the vortex indicator, we have also red line crossing above the blue, so we know the bearish momentum is taking over. Any pop in the dollar from here, we'll see the bear flag playing out for gold. What does that do to the gold miners? Because the gold miners outperformed. They did because of New Mount's earnings and the weighting of that company in the ETF GDX. But that's over now. That's behind us. If gold plays out a bear flag pattern, the GDX will follow. No doubt about it. You look at what's going on with the SLV here. It lost the 20 and momentum is still bearish. You see it in the MACD, you see it in the RSI, you see it in the vortex indicator. And maybe we're not done yet until the dollar flushes down. Otherwise, I think we have a correction in gold and silver. And by the way, you have to notice that gold has been rallying along with the market, but then also correcting along with the market, but not rebounding this week along with the market. And if gold flushes down, I think it's leading, if we use it as a leading indicator, it is leading toward the market rebound will be short-lived. The market and gold will trade together. That's the assumption for now. If we look at copper, what about copper, Maverick? Why is it outperforming gold and silver? We can speculate about the fundamental reasons all you want. I have my theories. I think it's because of China. But if you look at the weekly chart for copper futures, we're getting a little crazy here. RSI overbloated, MACD, vortex all overbought. We have trading outside of the upper boundaries of the weekly Bollinger Bands and maybe forming a rising wedge pattern. Any bad news would drop copper. And I think that we're going to know what the reason is behind the rally in copper. Once we get the drop, why would copper drop? If we get bad news from China, for example, then okay, we know that copper been rallying because of China. If we get bad news from whatever and it causes copper to go down, then we know for certainty that this was the true catalyst behind the rally in copper. If you look at UK oil, Brent oil, what do we see here? Still haven't crossed above the 20 days moving average. And the longer it does this, the higher the probability that this is a bear flag pattern. And oil bulls are not showing up here. They need to see a lower price. And if that is the case, we'll see the bear flag playing out in UK oil. It will lead us down, I think, to 85. Now, if we lose 85, that's going to be a problem. But I don't think we lose 85 until there is a recessionary piece of data that shows up. Otherwise, I think that 85 should be good support. And higher we go from here. Now, the XLE, the ETF for energy stocks, closing the week below the 20 daily moving average. Not a good look here. And the reason is Exxon has a huge weighting on the ETF. And Exxon reported earnings of Friday and the market didn't like it. I think that the good news were already factored in the recent run. So it is a long overdue correction in Exxon and it's pushing the XLE down with it. I'm not saying that oil has turned bearish. I'm saying that for now, oil is not a buy yet. It's a hold. If we look at the 10-year yield daily chart, what do we see here? We're actually moving higher, expanding the bullish momentum. Most importantly, the weekly chart, we're expanding the upper Bollinger Bands. The RSI is not overbought yet. The MACD indicator in the weekly chart suggesting that the bullish momentum is just beginning. I think we're going to challenge the highs from 23. If that is the case, what do we do with the yield-sensitive names, such as the XHB Home Builders weekly chart? Caught a rebound of the 20 weeks moving average. We played some of that. The question now becomes, when do you short it? Because we have negative momentum showing up in the MACD, the RSI, soon enough in the vortex, once we lose the 20 weeks moving average. If you look at the daily chart, it is just consolidating underneath the 20 daily moving average. If we close above the 20 daily moving average, then the odds goes toward, hey, wait a minute, the rebound probably has more juice to it. And then you have to play the 108.44 test. Otherwise, if we get rejected here from the 20 days moving average, then we lose the 20 weekly moving average, we got a bearish trade against the XHB. The IYR real estate daily chart, what do we see here? Number one, the death cross between the 20 and the 200 days moving average, 20 in white, 200 in blue. That's negative. That's not bullish. But if you look at the daily MACD, we're changing from bearish to bullish. At least this is what the chart is attempting to do. Even though the closing candle on Friday was ugly, it was a reversal candle. But you're not going to short the IYR until we lose 81.25. Then that's going to unlock the weekly chart. You're not buying the IYR until it trades above both moving averages, the 200 and the 20. Suppose it goes below 81.25. You look at the weekly chart. What does that suggest? We're probably going to revisit the lows from 23. Here's another yield-sensitive ETF, KRE for regional banks, hourly chart. What do we see here? Maybe a double top. Maybe we tried to close the gap on Friday and that was a failure. I'm not interested in shorting the KRE until we lose 47.5. And even if we do that, my trade will be all the way down to 45.5. After we lose 45.5, then the party begins. For the bears, of course. For the bulls, you're not going to buy the KRE here, I don't know, until it passes 50. For now, it's just not attractive. It's not out of the woods yet. Look at the VIX hourly chart. What do we see here? In the first leg of the correction, we've seen higher highs and higher lows in the VIX. This week, the bullish trend in the VIX was broken, indicating that the correction, at least the first leg of the correction in the S&P 500, is over, as the VIX gave us confirmation on its own hourly chart via a bear flag, via a lower low pattern, via breaking the bullish trend line, and then we get a market rebound. Here's what we have to watch for. We're now forming lower lows and perhaps lower highs. If that continues, rebound continues in the SPY. But look at the MACD indicator on the hourly chart, and then look at the falling wedge pattern, possibility off. On the chart of the VIX, what if it breaks higher though? And that begins a new bullish trend line in the VIX. We begin to see that, and that's building the new leg in the correction in the S&P 500. Big Kahuna Apple hourly chart, what do we see here? The magnet is 170, and the stock cannot make it above 170 and close above 170. Now momentum in the hourly chart is shifting from bullish to bearish. Do you short it at this point? Here's what you got to be aware of. The daily chart. Did we close below the 20 days moving average? That's sitting at 169.37. We closed at 169.30. Is that convincing enough to say that you should place a short in Apple? Not yet. We need to see a little more, then we can trade the lower Bollinger Bands in the daily at around 164. If we stay above the 20, then we trade the upper Bollinger Bands. That's around 175. Tesla, the souffle, hourly chart, what do we see here? The stock sold off heading into the earnings report. The report comes out. It's disastrous, but it causes short covering because the selling already happened beforehand. But the report is still bad. What does that mean? Once the shorts are done, possibility is we see the sellers showing up again. And maybe this is what we've seen on Friday, that we stalled at around 170. We're forming a bear flag. Momentum in the MACD indicator on the hourly is shifting from bullish to bearish. Are we going to resume the move to the downside and perhaps close the gap? Interesting assumption, but not yet. You're not going to bet on it yet. When do you do that? Here's your daily chart. Once we lose the 20 days moving average, that's in white. Otherwise, so long as we're trading above, possibility is the shorts are not done covering here. Now, the bears, of course, still have the advantage in the weekly chart of Tesla. Why? Because it is a bearish trend, and we haven't had a bullish engulfing candle erasing the highs of last week's candle, reversal candle. So we cannot assume that this is a reversal yet. And so long as it's not, it's doomed to fail. The possibility is it could fail. If it does and we lose 152.37 again, next stop would be 101.81, the lows from 22. NVDA, hourly chart, what do we see here? Possibility for higher low, perhaps. We're trading above 860, 824, all the important indicators. But look at the hourly MACD. Can it continue to go higher here without correction? And correction could mean consolidation. Sure, but for now, until you lose 860, or better yet, 824, you don't have a reversal yet. The momentum is now bullish. But then you look at the daily chart. I would say that the bulls scored some gains by closing above the 20 and the 50 days moving averages, 20 in white, 50 in blue. That's the good news. What's the bad news? You look at the weekly chart. Momentum is changing from bullish to bearish. No doubt about it. We don't have a reversal yet. until we close above the top of the breakdown candle. We haven't done that yet, so it could be a rebound for now, but any bad news coming from, let's say, Amazon or Supermicro or AMD, it could resume the correction in NVDA. And lastly, tulips, Bitcoin. What do we see here on the daily chart? Some weakening below the 20 days moving average, sure. Continue to watch the daily MACD. No confirmation yet of the shift in momentum from bearish to bullish, but that could happen any moment now. So you cannot short Bitcoin until we lose 59,224. Then that opens the path for more downside to come. Otherwise, right now, the odds say, looking at the MACD indicator, that the momentum is going to shift from bearish to bullish, and that's going to cause a breakout in Bitcoin. Until that's negated by the loss of 59,224, I think the bulls got the advantage here. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? We have plenty, but this Monday, the 29th, we got nothing, so we can continue that rebound that we began this week, but most importantly, Friday, after the AI optimism revival. But then comes Tuesday, the 30th. We have an important economic indicator, the Employment Cost Index, then the S&P Case-Shiller Home Price Index, along with the Chicago Business Barometer on top of consumer confidence. Wednesday, we have the ADP Employment Report, May 1st, followed by construction spending, ISM manufacturing, job openings, and then of course, it makes it the most important day, the FOMC decision. That could make or break the market. Earnings are important, but also important is the Fed's decision. Then we have Thursday the 2nd, initial jobless claims, trade deficit, productivity, unit labor cost, and factory orders, all important economic indicators. Friday the 3rd, the party doesn't stop with the Fed decision. We have yet another highly important indicator from the employment report comes Friday on top of hourly wages, which is included in the employment report. And then on the earnings report, we have also really important ones coming out from companies such as Eli Lilly, MicroStrategy, McDonald's, Coca-Cola, AMD, Supermicro Computer, Amazon. So interesting week ahead, folks. We'll be here. We'll cover it day by day, move by move. If you enjoyed the show, please help us out here by pressing the like button, subscribing, leaving a nice comment, and consider joining us as a member either here on YouTube or Patreon. Links in the description. But with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Thanks, Maverick.